Good morning and welcome to the September 3rd Thursday marketing meeting. I'm Sterling Smith, Director of Ag Research. Joining me is Brooks York. And we have a whole lot of interesting things to talk about. We have some big changes in the interest rate market. We have a little weather in South America story that's developing. And right now, as we speak, we have the Dow Jones Industrial Average and the S&P 500 both trading at all-time record highs.
Wow. We do have a lot to talk about today.
And if you want a little more good news, we have gasoline at its lowest prices in about 9 weeks.
That is good news. Sterling, I was looking at all the fuel indices out there, and they are kind of signaling some good things. Of course, we look at a little bit of that into our margin protection program that we've got and how that filters in. So all that's going to have a factor in that.
Oh, absolutely. It's good for, lower energy prices can often be good for cattle prices, put a little bit more money in people's pockets, and it's generally better for the economy. What's driving this lower is the idea that we're not going to see China using as much energy. They cannot get their economy moving forward. That combined with the U.S. having record crude oil production, that is working to keep at least prices contained to a fairly reasonable level. We're not going to see crude oil likely drop to $50 a barrel or anything like that. Frankly, we wouldn't. That would be the sign of a pretty deep recession, because at that level, that's more than it would cost, less than what it would cost to pull it out of the ground. But I do think we can settle into a fairly functional level right here.
Sterling, along with weather down in South America, I'm going to talk a little bit about basis and barge freight affecting prices for farmers across the country too. We're seeing some weird things go on in that realm right now. Of course, we had the hurricane last week, and we had a couple days of rain before that. So it's really kind of messed things up logistically for companies shipping and loading vessels down in the Gulf. We'll see how that plays into cash prices as well. So if you're on the river system, and even if you're not, it has some bearing on what's going on there. And then we've got some harvest results. I'd be interested to hear from some of our people across the country as to where harvest is, what they're seeing in the fields.
All right, so why don't we go ahead and we'll talk about basis first, and then we'll talk about South America.
I'll share my screen, and this is just a snapshot of what's going on in my neck of the woods. But we can kind of take a look at this and gather some insight for where you're at. This is a collection of elevators in my area where they're bidding for corn, soybeans, and wheat. Just as a side note, I'll throw this out there. This isn't the lowest basis level I've ever seen in our area, but $1.17 under for soft red wheat. We're in a very seasonal wheat market, as a lot of places are that grow soft red wheat. And so you basically have a marketing window of about 3 months unless you decide to put it in the bins. And in January, things get better, as you can see. Check that out, 10 under and 2 under for January. So wheat is definitely something you can put in the bins. But I really want to focus on corn because I think that's the telling story here. I'm going to pick on, let's pick on Shawneetown, Illinois, if anybody knows where that big city is. You see, we've got a big carry in the basis market. So September is at 44 under, where October is 32 under. So this is very, very rare for this to occur this time of the year. And essentially, we're normally in full-blown harvest along the Ohio River and the lower Mississippi. And what's happening here is, the market is saying, stay away from us for a little bit here. We would rather have it in October, which is somewhat rare. So there's a big carry in the basis market. So a lot of farmers are trapped here. They made contracts for October. Harvest is progressing nicely. Most elevators will allow you to roll that back at a discount. So there are some discounts taking place. Basis levels, while in our neck of the woods, 44, 45, 50 under is not good, they've actually held in there, I think, relatively well given the river situation and the amount of harvest pressure that we're seeing. I'll throw this out, unrelated to the river. the ethanol plants, which are Valero and Green Plains over here. They definitely lead the charge, and you don't see that. You don't see that big carry in the market there. They need a steady supply of corn, and they're willing to take it now. So this market right here will be the driver. And as long as we see this occur, it's going to keep these carries in check somewhat, because these guys are pretty limited. You guys know, if you deliver into ethanol, you may not get the most favorable hours, things like that. You may not get the most favorable contract options, but they're going to suck up a lot of this corn in the short term. When we look at beans, we've got a couple of processors on here. Got Bunge Caro, Illinois at 10 under, CGB Mount Vernon at 15 under. Definitely processing, leading the way there, Sterling, not a big surprise. However, the river is pretty strong. When we look at an ADM in Mount Vernon, in Indiana, Evansville, Indiana, things are pretty good on the river for beans. They've held together better than I thought they would, with so much bean harvest taking place on the lower miss. That's good news, Sterling. I think that signals something right there that says, we're hungry for soybeans. I noticed in your export report where we started, I think you started fresh this time around. And hey, we're up closer to the top of that, top of those lines.
Yeah, the exports, we just rolled over into the new marketing year. Export sales again for soybeans, again this week, were noticeably better. And that's good, because our sales of new crop through the year previous were not very good. We were behind on sales. And we are making an effort to catch up, which is good. And when I share my screen, you'll see why.
Yeah.
So
a couple more words on basis. I think basis may dip just a little bit lower. We're not to the gut slot of harvest on the major river contributors. So when I say basis in general, I'm talking about river led right here. I think we can dip a little bit lower over the next 20 days. However, I think we'll have a rapid recovery there. I think by November 1, we could see basis at even, maybe 5 under at some locations on the river. So if I'm a farmer, we've all of a sudden got to take that rush glasses off for harvest. And we got to think about managing the harvest here. Bean basis looks pretty good. If I need to switch over to beans for a while, I need to hit that bean market. I need to do everything I can to avoid that window of 21 days if I don't have basis set. And you got to ask yourself, at 40 cents difference between October 1st through 10th harvest and October 20th through November 5th harvest, is it okay to shut that combine down? And that's tough for farmers to do. Most will not, but probably if we look at it and make some plans here, that's going to be the difference in some of your better managers and the ones that just kind of want to get the job done.
Yeah, and interior basis, probably we'll see a different story early. But if we see river basis hold up, maybe some of that can spread. But there's a lot of corn still in farmers' hands, and not having close access to that river could prove to be a little bit difficult. We'll just see how that plays out. But here's something everyone has been pining for: good news from me for months and months and months and months.
I don't believe this. I don't believe it.
I'm going to share. It's not really, I wouldn't call it good news, but it's bullish news. Can you all see my screen there? What does that say in the headline there, Brooks?
Oh, it looks like drought in a good spot for American farmers.
Worst drought on record lowers Amazon River to all-time lows. The entire country of Brazil, most of the growing of soybeans occurs central and southern Brazil, which is well south of the Amazon. There is a drought that extends all the way from Mato Grosso and in Sao Paulo all the way up into the Amazon. And this is serious drought that is producing wildfires. Drought, we're seeing humidity so low that farmers can't plant. Brazil is normally a very wet place. And if this continues, right now it's just kind of slowing and being a bit of a hampering issue with planting soybeans. If this persists, we're going to have a problem. A good problem if you're an American farmer, a bad problem if you're going to need to import soybeans. Right now, CONAB thinks Brazil is going to make 166 million tons of soybeans. That's about 5 million, 6 million more tons than they produced this year. How much is 6 million tons? Normal, when we see one of these flash sales of soybeans, normally it's 120,000 tons. 6 million tons is 50 of those flash sales. Okay? We don't get, if we get 2 a week, it's a good week. So that's enough to really cause a problem. Now, if this drought continues and moves on and extends itself and we begin to see problems developing with the crop, that will, obviously be something that will help put a floor under soybean prices and hopefully under corn prices a little bit as well.
Sterling, I'll stop right there and kind of translate a bit. I think you said 166 million metric tons. Is that the number you just said?
That is the number that CONAB put out yesterday.
6.15 billion bushels. And we're talking Brazil alone there, just to kind of give you an idea. Considerable amount higher than what we're producing here in the U.S. Just a big number. Sterling, if I'm not mistaken, last year yields were down just a little bit. Would that be about a 16% increase year on year on production?
I think our total production was about 156. We haven't gotten the final numbers.
Yeah, it wasn't quite as low. So about 10 million metric tons. 10 million metric tons.
So you call that 7%.
Yeah,
7% increase. Which, seeing that increase at the margin, that is a lot of soybeans. Soybeans, we're good at getting rid of them, and they do disappear. But even that's going to be a little bit of a big thing for the soy market to simply swallow, because you can't amp up cattle production that fast. We may see, good news for pork and chicken prices at the retail counter, but not necessarily something that would be that stimulative. Going back to the energy market, remember, this is all interrelated. If we see soybean prices go up, that makes it harder for China to produce more hogs. When they can't produce more hogs, that's very hard for them to stimulate the economy. One way they like to stimulate their economy is to try and drive food prices down. Well, if you see a tighter soybean supply, that is going to force their hand a little bit, and that may very well, work to help keep energy prices at least a little bit contained. One thing I'd like to point out is when you look at today's DMO, there will be a copy of today's drought monitor in there. It's not exactly, rainbows and unicorns here. Most of the country and almost all the growing area is either in excessive dryness or seeing drought. We've gone 21 days here without a drop of rain in Omaha. My yard went from healthy to burned up to now it's a complete disaster. I'm just going to plow it over and put in AstroTurf, I think. But
Sterling, and that's the case. I mean, that's the case here as well. Probably not to that extreme, and really not much different between Southern Illinois and Nebraska. So we've got a lot of listeners on here that are probably in a similar situation where we've had dry conditions for 30 days. We kind of think in our mind the crop was primarily made before that. But I can't help but, as I see soybean yields and as I walk out into a few of ours, it looks like the beans are smaller. It looks like it has had a little effect on the beans. Corn, it's really too early to tell, because in Southern Illinois, we're just now kind of in our beginning May planting corn. And so a lot of that matured, probably didn't have a big impact there. But as we get into that May 10th through June 1st plantings, we'll see if it had much of an effect there. But I think it might play a role in soybeans, and maybe that's why we're stabilized in price right now.
Yeah, right now, before you can have a bull market, you have to kill the bear. And maybe right now we're starving the bearish part of the market. Right now, corn yields for the USDA is at 183.6, an all-time record. We are going to get a little bit of rain allegedly this weekend, just in time to ruin my golf game. But how much we're going to get is questionable. And the disbursement of it, it's not going to be anything that's going to change things too much. Maybe we'll see. The forecasts are a little out there on it. But this is going to take some of the edge off of that corn yield. There is no question about it, especially areas east of me when you get into Iowa, where you have a lot of dryland farming. You are going to see some of this edge is going to come off the yields. In fact, I think I'm going to go ahead and speculate on what a January yield will be. I'm going to say it's going to be, we're at 183.6 right now. I'm going to say we're going to take that. We're going to still make a record, but we're going to be at 182.1 on corn. That's only a bushel and a half. That's not that much to peel off historically between, September and January.
Wow. So I don't know what's going on with you today. First, a little bullish comment right off the bat, and now you're taking yields down. So, Sterling, are you using history to forecast that at all?
I do. I always look at the history and the amount of change. And very often, the most exuberant predictions we get for yields in corn occur July, August, September. That's when the great enthusiasm, that is when the hope of the great yield is there. Almost every single October, sometimes November, never in December, and occasionally in January, we see those yields get cut back. That's just how it rolls. Soybeans often are a little bit different, but I think again this heat is enough to take a little bit, maybe a tenth, maybe 2/10 off of soybean yields.
Yeah.
And here's the thing: it could, if it rains this weekend and then it rains next week, you can put that 2/10 right back into a lot of these beans.
Yeah. Yeah.
So
I'm really curious. I know not everybody's got chat, and I'm tempted to unmute panelists on here because I'm just curious what they think of that 183. I've gone back and forth, and Sterling, I've got that bad deal of looking out in my backyard and seeing yields in my backyard to try to predict the national average, and you can't do that. But I'm
that's
just curious
dangerous behavior. That
dangerous
is
behavior.
localized bias. That's really bad.
It's funny, as bullish as I was last week looking at things on corn and looking at all factors, not just conditions in the field, but everything that we talk about here. For some reason in the last 24 hours I kind of turned into this bear, and I think to myself is you got to use reverse logic on this market. But I'm curious what everybody thinks on that 183. Sterling says lower by January. Use that chat button, or if you can put your hand up, I'll unmute you if I can. But if you can use the chat box, that would be great. Higher or lower than 183 is the question.
Here, I'm going to pull up a heat map of exactly what I'm talking about here. That way you can see what's going on, that I'm just not, getting all wound up on a Thursday here. Let's see. Seasonal, we'll do 15, we'll do 10 years. 10 years probably good. Heat map. Okay.
I use this heat map in a lot of my meetings that I do. And when Sterling says he uses history, this is going to be pretty telling as far as the red and the greens that you see on here.
So right here, this was the yield per acre. We bumped her up hard in August and again in September. That's a little bit rare. Now notice here, we're going to go back to 2018. Bumped it up hard. Then we took some off and we put a little bit back on. But we weren't pushing at record numbers in 2018. But if you notice, this October, the trend in November, that when we've been higher, very often we turn in and come out a little bit lower. So
Pretty
that is
interesting.
that is the typical bias. And again, you kind of have to look at it on a relative basis when you're predicting a record yield like 20 in 2018, where we added so much. We started from a pretty low number and built onto it and took it off. But when we're coming from a high number, that's when you start to see this sort of behavior go on sometimes. So I think we are going to prove to be a little bit too big, and taking, a bushel and a half off. This is a net change in bushels taking off here in 2021.
Sterling,
Took 4 bushels off in January.
let me share a screen real quick to kind of show the impact of this, okay? And this isn't a great one, but I'm going to go ahead and pop it up just to kind of give you an idea. Let me see if I can get back to that. Let me see if I can get back to this. What does it mean to take that 1 or 2 bushels off? Let's just take a look at this. Carryouts right now, to 2 billion. Let's just say 2 billion sterling for easy math here. And you've got the 183.1, and you're thinking 182. What was it? Your guess was 182 what?
182 spot one. We're going to take a bushel
Okay.
and a half
A
off.
bushel and a half, and so that's 82.7 million acres. Okay.
Yeah.
Gets us down into the 19s. Okay. Let's, Sterling, I don't want to take you on a tangent here.
Brooks, you with us?
Sterling, I'm back. Sorry, that's the downfall of Starlink. It resets every once in a while. But this export number, and I don't know if we want to go there right now or not, but I'm going to mention it.
Yeah, let's go there because I know
I
right where
think
you're going.
I think at one point in time, a month or two ago, we thought this thing could be big. I mean, really big. Like if China steps in, like 2.6 billion big. Those things that's probably a pipe dream at this point in time, unless we see some type of major stimulus program that Sterling mentioned. However, the 2.3 billion number that's projected can go higher. What's that likely window? I put on there 2.43 to 2.5. I've thrown out Ukraine. I've thrown in Argentina. Sterling, to give you an idea, what could we trim this carryout number to, this top number? Maybe it could get trimmed down to 1.8-ish billion, 1.85 billion. There's some private analysts out there that are mega bullish at 1.71. I don't think that can be the case.
That's going to be awfully tough.
That would come along with a 180, 181 type national average. We'll see. I just want to throw that in there to see how it all kind of melds together to dwindle those supplies.
Yeah, how we would have to get there. One, we need that 181 spot. 1, 2, that lower yield. That will take 120 odd million out of the carryout. That's the first step. The second step is we are going to need to see Brazilian early first crop corn production go down. What that means is normally in Brazil, mostly you plant soybeans in September, but you plant a lot of corn. You don't, it's not for nothing. And then you rotate. If the drought stays in place, you are going to force some natural tightness into the corn market. China is going to be looking elsewhere to buy corn. Don't count on them looking towards us for much. Don't count on it. But assuming our export pattern to Mexico, which, by the way, for the marketing year, best year ever for exporting corn to Mexico, far and away. When you look at the charts, you can see last year was a big year. If we can continue and see some growth with that and a little drain off, maybe we can take 100 million off of that on top of the yield. So maybe you could cut 2.5. And I'm only speaking from now until January because we have to pay attention to that weather pattern. A La Nina is forming and will probably be in place. Probably. is being the operative word. If we see that, we're going to be looking at drier conditions for the U.S. We will be looking at drier conditions for South America, and a market that will probably still be short speculative money. Probably not as big, but still short. And prices probably haven't moved up that much just yet, simply because we have so much corn coming to the market. Remember, we got a lot of last year's corn. That creates futures contracts that will be sold when it comes into the elevator. We have the fund that needs to buy because they're short and getting a little uncomfortable. Those two collide, and that creates the price dynamic. Right now, it looks like it's going to be tug of war time where we get caught in a range. We need something to either A, not bring that corn into the market and get it sold, or B, something to make those funds want to buy that corn in a bigger hurry. Or moreover, just cover their position and decide, hey, I don't want to be in the corn market. It's going nowhere. I want to go buy S&P futures or sell bond futures, whatever it may be. It could be something else that helps move that. So a change in the dynamic in place has to happen. And I'm only willing to go out until January simply because the weather in South America is a bigger deal than the weather in the US.
Yep. Yeah. You know, lots of dynamics taking place. It's kind of a fun time in the markets because there's so much potential out there. Now, Sterling, as mildly optimistic as you are today, I can't say bullish because it just doesn't go with Sterling right now. But as mildly
we are not bullish. We have moved into a situation where no longer hugely bearish. Okay, there's a big difference. Trying to be bullish and being long corn right now isn't going to be much fun. Okay,
we'll take what we can get with you.
If you can buy it cheap at $3.90, you probably will be able to sell it at $4.05. Wash and rinse and repeat. But if you buy it at $4.05 on the idea you're going to $4.50, you better make sure you got plenty of peps and plenty of money in your margin account because you're probably going to be going for a ride for at least a while.
So let's temper things right now. You guys have seen the charts that I've thrown out about 4 prolific years in agriculture. We can have blips on the radar nearly every year. This is probably a blip on the radar. Even if it's a problem in South America, it's easily corrected. It's corrected within 12 months. Okay, folks, 12 months. What it means is we're looking for excuses to plant more soybeans in the United States because of cash flow on the farm. Our farmers would love to plant more soybeans. We will take care of that problem. If we see opportunities in the next 90 days, and that's the window, maybe 120 days. It may not only be a good time to make old crop sales. It may be a very good time to make new crop sales going forward. Huge carries in this bean market, huge. If we see that bull kind of raise its head a little bit with this South American weather, we got to take some action there. Sterling, agree, disagree?
Yes, we need to pay attention very closely to how the South American weather situation develops. Simply because if 4 weeks from now, when we have, I'm going to get Jeff Dorn from Planalytics on, and we're going to talk about the South American weather. If it starts raining 4 weeks from now, we're going to have a problem because all of a sudden that 166 million ton crop, well, maybe you don't get 166. You only get 165.1. Okay. All of a sudden we're going to have a problem. And looking right now, you've got a 50-cent carry from nove to nove in the soybean market. So pay attention, because if we manage to get enough of a nervous little jittery short covering rally, that will probably push the nearbys maybe 25, 30 cents. If you do that on the noves, all of a sudden you're looking at nove 25s around $11.
Yeah.
you know.
Yeah, I think that is a pretty good mark to put down. Be honest with you. Um,
I wouldn't sell the whole thing there.
you're right.
I wouldn't, but I'd put a little bit on, especially if 11 pencils for you, you want to sell a little bit there.
Tell you some strategies some folks are using, not for new crop, but for old crop. In really the Delta, the Southeast, as we get into the lower Ohio and central Illinois, farmers have to have cash, and soybeans turn into cash faster than corn. So soybeans going to town right now, a lot of them are at least, if they're not priced, they're going to get priced in the next 30 days. I've had a lot of farmers and a few agents call over the last week saying, "Hey, let's build an option strategy." And this is one of those things. You're buying an option not to gain 20 or 30 cents in a market. You're buying an option just in case Brazil has a huge drought and prices go to 11.50, $12. Okay, so keep that in mind. We're not going to gain anything if the market goes up 50 cents with buying call options or even bull call spreads. If the market runs a lot higher, yeah, you will gain something. But I'm seeing a lot of interest in just $11 March call options. Those are trading somewhere between 20 and 25. I'm not going to bat an eye at that for that kind of price. You're protecting that move that takes us $1, $1.50 higher. That's fine if you want to be there. Seeing some bull call spreads where you buy a call closer to the money and sell one outside the money. These are a little tricky from the standpoint of you're probably not going to make more than 30 or 40 cents on a move. And on a bull call spread, at when you buy that call close to the money, sell the call out of the money, you really owe it to yourself to let that thing work deep into the pricing period. And unfortunately, if we see that pop up and it's on a weather scare and rain happens, you're not going to get that big benefit because of that short call that you've got out there. Sterling, have you heard
Yeah,
of any other strategies?
I'm actually coming up with something here. I need to get some prices. If you think an $11 call on March is a good idea, I think there may be a way to, let me get this, March. There we go. Let's adjust this. Okay. So we're going to go out here. We're going to look at, well, March 25. There's my, let me find my strike prices here. Here we go.
While you're looking at that,
Okay, here.
did get
Got it here.
did get a few out there. Kathy says same or higher on that yield. Wayne in Ohio says lower than that yield, and Jason updated us with some basis levels up in way up north in North Dakota, and we don't want those through most of the country, Jason. We don't like those. But Sterling, you got some news for us?
Well, what I would do, now this is a little complicated. We're going to buy an $11 March soybean call. Okay. We're going to pay right now, we're going to pay 22.5 cents.
And it means you've got the right, but not the obligation to buy those futures if you'd like.
Mm-hmm. At 11 bucks. You're going to be, then what I'm going to do is I'm going to sell two 1140 calls at 13.5 cents. I'm now a 4-cent credit. Then I'm going to buy one 1180 call. I'm going to pay 8 cents for that. So for 4 cents, I'm going to pay 4 cents. If the market moves between 11 and 1140, I make 36 cents a bushel. Okay. As long as it doesn't, if it goes above 1180, I don't lose any money. This is a risk-free trade. It's called a butterfly spread, and you're only paying 4 cents to do this. Okay. This is a precision operation, and you need this for somebody who pays attention. It's a little complicated, but for 4 cents, it's a pretty good deal. Ideally, And here's something else that you could do with that. If you buy that March call and you pay the 22 cents, we find ourselves at $11.40. Okay. You can then apply this trade that I just told you. You already have the 11 paid for. You sell two of the 1140s and buy one of the 1180s, and you'll be able to do that for a substantial credit, meaning you will lock in a credit. You will get paid to put that on. If the market stays at 1140, you will also make the 40 cents on your original position. Okay.
And I'll reiterate what Sterling said. This is where the marketing guy says, kids, don't try this at home by yourself. Probably, it takes a watchful eye on this strategy. Now, you want to know how people make money trading options? Sterling just illustrated it. This is how traders are going to make money trading options out there. Farmers probably would scare most of them to death, but it kind of gives you an insight into the mind of a trader rather than the mind of a farmer. But an excellent strategy.
Yeah, this is something, and again, if you buy these options that are out of the money on the new crop and they explode up in value, you have a lot of choices when that thing is profitable other than just selling it. There are things we can do. So if you're buying these $11 calls and all of a sudden we find ourselves at $11, please pick up the phone and call me.
Do something.
Talk about this.
And that's the
there's
issue.
things other than, because the worst thing you can do actually on that trade is selling the thing outright.
Yeah.
Okay. Deep in the money options are a problem. You always want to be right around where the market is. That's why at 1140 we sell those two calls, we buy the 1180, and that creates a much better, much more guaranteed profit situation.
Yeah, that's where you turn that singular long call into something else like a bull call spread.
Yeah,
To at
that's
least
exactly right.
portion of your money. Management of options is probably the number one detriment to farmer hedging. That's why they don't like it. If you think about it, they buy the call option, they watch it double in value, and what happens? Greed sets in. We're going to let that thing go. Not a good idea.
And that is the thing you do not want to do. When you have a winning hedge, you have choices and things. What you want to make sure is you get paid. The last thing you want is you've got this hedge on and it works. Beans go to 1140. Then we get an acreage report and we're planting soybeans in the highway medians. The thing goes limit down and your option drains value like that. That's what you want to avoid.
Sterling, I've got kind of an interesting price chart. It's not time for it in the segment, but before we're done, I want to kind of show you an actual price chart from the last 120 years and how it compares to the consumer price index on corn. But we'll show that a little bit later in the show.
Well, let's see it. Let's go ahead and see it here.
Take a look at it here. It may take me just a second to pull it up. I apologize for that. WebEx is sometimes a little bit challenging to do that with. Let me see if I can get it. All right, it looks like I'm closer. But it was just kind of an interesting chart, and it kind of goes back to, I use this to kind of squash long-term bullishness, okay? And that's why I said earlier, if we see opportunity, let's run with it. But this is a really, really interesting chart. It came out of Pro Exporter in Kansas City. They call it the 5 super cycles. And I've shown a very, very similar chart to this. And you can see down at the bottom, we go back to 1905. And let me illustrate why I'm so adamant that if we see opportunity, we don't just jump on it for old crop, but new crop. You're going to see these 5 super cycles. World War I, you see kind of a half one here in World War II. You see the 70s, you see the ethanol boom, and you see the COVID boom. They call it the stacked event. Someone call it the COVID boom, Sterling.
We had three major weather problems in the U.S. We had the water in 2019, the derecho in 2020, and we had a drought.
Which is combined with a new corn buyer for U.S. corn. that bought a lot of
Exactly.
corn from the U.S. So
Yeah.
we had demand. First of all, we had to have some type of prolific demand take place. Second of all, we had a little, not terrible yields, but just enough off to keep the fuel fire burning.
Right.
This right
We had a
here,
supply plague.
yeah,
It wasn't terrible, but it was just annoying. And we kind of, well, we got carryouts down to 1.4, 1.3. So that's pretty tight,
we go
tight
right
enough.
here. We've got to feed two armies in the field. We've got to help repair a continent. We see the same thing here in World War II. A big demand showed up. A big demand showed up. Lots of stuff happened here in the 70s. I won't go into it, but lots of stuff happened here in the 70s. A really good time. A big demand as far as ethanol. The Chinese corn demand, the Chinese picking up from the ashes of COVID, along with all those supply events Sterling talked about. Um, Kind of interesting. This is the actual corn price unadjusted. This is what farmers got paid on average. This is corn price adjusted by CPI. Now, Sterling talks about CPI a lot, Consumer Price Index. Just kind of interesting to see how good times were here in World War One, World War Two, the 70s really strong. And you know what? Maybe not quite as good as we thought they were here over the last few years versus CPI, just for perspective. The point I want to make with this is in each one of these super cycles that we want to call them, Purdue University would call them 5 prolific events. The catalyst in almost all of them was massive demand increase or significant demand increase. Sterling, we don't necessarily see that around the corner right now. So when we're talking about this situation where we might be able to benefit from a drought in South America, we've got to look to years like 2003, 4. You see that one pop-up year. Sterling, you're probably better at this than I. 83 would be a good one. A pop-up year.
Yeah, that was the year of the drought. That's when everybody in Chicago,
Yeah,
or it
we
was 94. Yeah, the drought.
point being significant supply issue we take care of quickly, very quickly. Um, we'll take care of it in 12 months on average. When you got to have that big demand to really put these things up for multiple years for opportunity. Sterling, I don't see that big demand anywhere unless it's SAF, and we're years away from that.
Yeah, we are. Maybe we see some feed demand pick up globally. Maybe a little bit. Ethanol demand, no, we're as good as it gets, and we have some risk that that could go down. Um, so as far as seeing any big new thing to raise demand, barring some sort of great discovery or change in technology, which we never know, that can always happen. We can learn how to build batteries out of corn syrup or something. Um, that's going to be so we're going to be dependent to get these markets to go up on having weather problems. That's the weather and or trade problem.
So anyway, on with the show, Sterling. Sorry to take you off on a tangent there.
Oh, that's okay. That's the tangent. And what notice, we're not as screamingly bearish as we have been in the past. You know, it's progress. And you want to see some real progress? Let's see what we got here. Let me show you some real progress. This is a chart of the S&P 500. Please note, new record high. We gapped open. We exploded higher this morning, opened about 65, 70 higher, and we have been running with it ever since. So this was the old record high, and we've taken this out. I normally don't like gap opens. We didn't trade that well on the interest rate cut yesterday, but the rest of the world really liked it. Came in here and gave us a strong bid, and now we're seeing the good follow through. Typically, the market after the first rate cut does run up. It's that second rate cut that we need to be watchful for. I would like to point out that these rate cuts are coming in a different frame than what we usually see. Usually, rate cuts are coming when there's a problem with the economy. Think pandemic, great financial crisis, 9/11, things of that sort. Those are the things when we see interest rates get cut. The only reason interest rates went up is because we had to put a lid on inflation. For the most part, we saw food prices actually come down 0.2 in the last high speed data. So inflation, for the most part, has stopped, meaning prices are not going up anymore. It doesn't mean things are going to get cheaper. That, that can of soup that went from $1.89 to $2.49, it's going to stay at $2.49. The good news is it's not going to $2.79. That's the good news. So that has worked to lift equity prices pretty much across the board and set new record highs. If we get the second rate cut and can avoid unemployment going up, which unemployment remains at or near record low levels, and we can avoid any resurgence of inflation, that normal correction that we see on the second rate cut may or may not be in play depending on where the market is. So we do need to pay attention here. But right now, the market does actually look and feel pretty good about things and seeing interest rates back up. There's trillions of dollars sitting in money market funds that aren't going to be making as much money as they were making. They're making less money today than they were making 2 days ago. So some of that will get pushed into risk assets, and that should work to help push the equity market higher, at least over the near term. September is normally the worst month of the year for the stock market. And as you can see, we started out September. It wasn't great guns, but now we've moved higher. And September's where we have actually traded better. We have actually pushed higher. I haven't looked for that in election years because here's the thing. Politicians and elections take a lot more credit than they deserve and pass along a lot more grief than what is really relevant to actually how the economy works. Meaning, person I trust least on economics, other than I trust Donald Trump next to least on economics. The only person I trust less is Joe Biden. Person I trust less on finance is Joe Biden. The person I trust less than that is Donald Trump. Okay, that's how I see it. And statistically, I can prove it out that my point is, in fact, probably closer to what really happens. Bottom line is, no matter what they say on TV, election probably doesn't matter. If unemployment stays reasonably contained, interest rates come down, energy prices stay stable, maybe a little bit lower at the pump where we are, S&P should be able to finish the year closer to 6,000 than where we are right now. There you go. There's my second big prediction.
So Sterling, you kind of spelled out where you're at on politics with us. I don't know what you're going to do when you
my
get
standard line: all politicians are equally worthless.
I don't know what you're going to do when you get in the behind the curtain this fall. I think you're going to have a hard time deciding. You might try eeny, meeny, miny, mo. That might be your best option.
Strategic voting to make sure I can offset either one of them, so neither one of them can do too much damage.
There you go. I like that.
That's the goal.
There was a movie in the 1980s that I think it was No One Above, or it was Richard Pryor movie. Maybe Richard Pryor can win this presidency. He might have a better chance than others, and he's dead. So now, talking politics just a little bit, you can't help but notice the Trump assassination attempt out in Pennsylvania sent our protein markets into a tailspin. I shouldn't say protein markets, corn, beans, wheat markets into a tailspin. I couldn't help but think maybe Monday we didn't see just a little bit of that with the attempt on the golf course our markets get jittery with Trump. And I'm assuming that's primarily due to Mexico and China. Fill us in on that.
Well, Mexico is our biggest buyer of corn. No ifs, ands, or buts about it. And by a big margin. Okay. No question about that. China is our biggest buyer of soybeans. No question about it. There is another supplier in the world now, and that's Brazil. We saw how much Brazil's production has amped up since the trade war with China. Very simple. Where do those beans go? They go to China. It's that simple. They don't want to buy beans from us. They don't want to be dependent. And that's when you have an import-export market, it creates dependency. And if there's a threat of tariffs and things like that, all of a sudden, China in particular, when they said they weren't going to import any more beans, it stopped immediately. It's a command economy. They say they don't want to import beans from us. They can do it. They don't want to import corn. They can do it. Mexico's a little bit different. Their economy is not as nearly as locked up as China is, and they're going to be dependent on this corn. So if we can keep the trade ideas and deal with the problems and do it without, setting anybody's hair on fire, we shouldn't see anything that causes too much nervousness in the global grain market. Yes, there's a lot of soybeans out there in the world. But we're also making more soybean meal, and that's helping the export situation a little bit. We are doing better exporting meal, even though the fact that we have more crushing capacity, it's helping keep prices. If we didn't have the extra crushing capacity, would be lower. So it's providing some support, but it's not something that can put beans back at $14 in our current paradigm.
Sterling, we don't talk about it a lot, but JP Morgan continues to be pretty bullish metals, specifically gold. Okay, I just have the question. I mean, some of the traditional thinking on gold was a hedge towards equity markets, but I think some of their guesses, and they've been spot on for the last couple of months. I'm thinking they've got gold predicted at 28.15 by the end of the year. What gives with that?
Okay. Don't confuse the behavior of gold with how gold coins and gold futures and gold this and that are marketed. Okay. They market to fear because that is marketing to fear works. Okay. You have a big chunk of the population that's afraid of everything. And when you pander to those fears, you can get people to take action because of their fear. And that has been a big way to market gold. Now, what did I just say 5 minutes ago about where the Dow Jones and the S&P are, Brooks?
I think you said at the top of the heap.
Record high. This is a chart of gold. Where's it? It's at a record high. How interesting is that? Where normally if gold is bought because, oh my God, the world's going to end, there's going to be a panic and all this other stuff. I remember the Boston bombing. This would have been back, in 2014. I was supposed to be on the CBS Nightly News that night to talk about gold that was down $135 that day. The shooting happened. Gold finished the day down $170. So gold is anti-dollar. Gold is anti-interest rate. If interest rates are going down and the dollar is going to be sideways to lower, gold becomes a favored asset. We have a situation where we have two sets of interest rates going down globally at least. We have the United States lowering interest rates. Just this morning, we have the EU. They're keeping rates steady for now, but they were pretty clear that their next move was a cut. So we have two economies that occupy about 810 million people, and the two biggest currencies dropping their interest rates at the same time. That will keep those currencies a little bit soft, and that can lead to support to gold. There's also a seasonal tendency to see buyers from India come in leading up to the December holiday period, which provides also some additional support for gold. Full disclosure, I am long gold and gold mining shares. So I am talking my book here. But I do agree that we do have some potential here to move higher and perhaps even hold some sustained higher levels. Silver is well below the record level simply because of the Hunt brothers and the issues with that. But silver will get drug along. It is a lot harder to trade than gold. Gold is much easier on one's stomach and one's nerves than trading silver. Silver is a big contract, and it's kind of like trading soybeans in a mental asylum of sorts.
Say that one again. I want to write that one down.
Well, silver is a 5,000-ounce contract, so it's the same size as a soybean contract. Soybeans can swing $3 a day sometimes, so it's like trading beans in an asylum. Because if you have a $3 swing in a soybean in a silver future or a soybean future, that's a $15,000 swing. Okay, and the margin requirements on trading silver. Well, here we'll punch it up here real quick. Just this is for everyone's benefit, having been a broker and seeing people trade this. If you want to own silver dollars as a metal going up thing, that's great. That isn't going to be so rough. But if you look at silver, right now we're up 54 cents. So that's a $2,500 move so far today. If you're going to trade one future, the holding requirement on the silver, notice here, no daily price limits. Buckle up. And your initial margin requirement is $11,550 to trade one regular silver contract. It's that high for a reason.
Yeah. Yeah. Well, Sterling, we're coming up on an hour. Anybody got any specific questions you guys would like to throw out there? And I'll experiment with unmuting. Wayne just put on here. Trump said yesterday he would put a 200% tariff on cars coming from Mexico. So just to kind of solidify that, that scare in the commodities market with Mexico and China. That's a good point. Anybody got any questions? And if you can't type them in, raise your hand and I will unmute you if I can. Jessica will tell me whether I can do that. Anything?
200% tariff on cars coming from Mexico.
Jenna, Jason, Eric, Cole, Brad, any questions? Let us know right now.
You can buy stock in Donald J. Trump and his media company. Did you know that, Brooks?
Yeah, I hear that you can get quite a buy on it here over the last couple of weeks.
Well, here, we'll punch it here. We can punch up a chart here. Here you go. Oops, DJT commodity. Actually, we need DJT. There you go. And yeah, it's we're down from a peak of at a high of $79.38 a share. We're now at $14.99 a share.
Wow. So is the spread long Trump media and short gold? Is that the spread you're suggesting, Sterling?
And doing that could prove to be kind of painful. One thing about this company, when you pull up and do the financials, it has no earnings. It has negative earnings. It is a company that is losing money. And normally when you see that, stock prices don't trade at multiples to infinity. So,
well, Sterling, I think it's probably time for us to sign off. Any final closing thoughts for the group?
As far as today goes, as long as the stock market finishes the day higher and up in positive territory and we don't reverse from that gap, that looks pretty solid over the near term. Crude oil and energy trying to get its act together, but wobbling. So no great news there. And corn is struggling mightily this morning. So we need to get that yield prediction I've got out to the media. So maybe we can spark some buying or at least stop some selling.
Absolutely. All right. With that, we will call it quits for the month, I guess, on the marketing meeting. So we've got a little bit of a break before we're really back. WASD is coming up in October. And
we have a quarterly stocks number coming out.
Yeah, we do. Actually, that's going to be a broadcast at the end of September, and that's coming up on the 30th on Monday, I believe.
On Monday the 30th, yes. Yeah. And so we'll have the WASD, which should be interesting. And for the next Thursday meeting, I'm going to try and get Jeff Dorn from Planalytics And in lieu of that, we'll get another meteorologist if we can't get Jeff and go over what the South American situation is all about. Because at that point, it's going to start to really matter.
Well, very good. Everybody have a great Thursday, and we will talk to you all later.
Thank you.